Having watched the video, Getting Started with Easy Mode, we can now explore what to do with all the information created by Financial Mappers. Financial Mappers is designed to make dynamic changes, explore new solutions, and print full reports. On the Report tab, you will find 3 sets of reports. If you are using Financial Mappers Pro, your advisor may have created some special reports in a 4th panel which are specifically for that company's clients. A selection of reports have been chosen to discuss in detail, as these reports will highlight the features found throughout all reports. A second longer video can also be viewed. The first set of reports are called Essential to View. They are Plan Outcome Summary, Plan Statistics and Indicators, Check Your Plan Outcomes, Insurance Needs Evaluation, and the Wealth Guidance Report. With each of these reports, the Easy Mode sample plan called My First Practice Plan will be used as the example. The Plan Outcome Summary is different to other reports in that it is a display of all the essential information you may require about your plan. The graph format may be downloaded as a PDF, however it is intended to be used as a summary of all the plan's details online. There are 4 key indicators which should be your first point of reference as you make your plan. If essential data has been omitted from your plan, the effect is likely to show up in one of these 4 graphs. For example, have you entered your salary and how much you will be allocating to your investment plan? Have you allocated sufficient salary savings to pay for your home and investment loan expenses and distributed the balance of the funds to your other investments? In the retirement phase, are you drawing down sufficient funds from your account? Or, as in this case, in the first 5 years, excess funds have been allocated. These extra funds will remain in the transaction account. And finally, the most important item is the balance of the transaction account. Financial Mappers is dynamic software and does not stop when you spend more money than what you have in the bank account. The overdraft will simply increase. This is an example of an overdrawn transaction account. This report may be saved as a PDF file. However, normally you would simply run your mouse over the graph to read the future anticipated results. On the summary page, the information may be displayed in either future value or present value. Present value are figures which equate to what you could purchase with that money in today's dollar value. That is, the future value has been discounted for the effect of inflation. The data has been divided into 5 yearly sections for both the savings and retirement phase. In addition to viewing the exact results, you may choose to round these values to the nearest $1,000. Some people have difficulty with large sets of figures, and this will simplify the view. When you click on a link, the underlined words such as assets at end of year, the underlying detailed information will be displayed. The first set of data is your assets and liabilities listed as investment assets and liabilities, home assets and liabilities, and retirement accounts. In this example, the liabilities are low and difficult to see. When this occurs, you can use the zoom feature to view the results and reset the graph. Both personal and investment income and expenses are displayed, as well as the income generated in your retirement accounts. One additional feature is the inclusion of the capital growth anticipated from managed funds and share portfolios, as well as your investment properties. After using Financial Mappers, you will start to identify the colours employed and you will learn to read the graph. For example, look at year 19. There the investment property was sold. There is a very big capital gains tax bill that year, and you can see that there is no further allocation of capital growth. The wonderful thing about Financial Mappers is that when it comes to calculations, it will do all the heavy lifting and displays that information in an easy to understand format. This is where your advisor will add value. Your advisor will talk to you about your future plans and build a plan which will take into consideration your risk tolerance. For example, if you don't like debt, a plan may be built where the debt is kept moderately low, as is in this case. The debt servicing ratio is the percentage of your after-tax income allocated to the repayment of all debts, including any planned additional payments. If you have read any books about personal finance, you are sure to have heard about estimating your retirement income as a percentage of your salary. It is often quoted that you will need 65 to 75% of your final salary to maintain a similar lifestyle. In Financial Mappers, on the plan page, you can enter a benchmark salary. This salary is used to calculate the percentage of income. In this case, the benchmark salary has been listed as $120,000, which is the salary entered in Step 3 of Easy Mode. Financial Mappers will consider all the income and capital growth from your investments, including retirement income, and calculate 2 returns for each year of the plan. The return before inflation is called the nominal return. The real return discounts the value for the effect of inflation. As an example, if you wanted a real return of 5% and the inflation rate was 2.75%, the nominal return would be 7.9%. Inflation will vary from year to year. However, Financial Mappers must use one average inflation rate for the whole time period. Using your real return as a benchmark is a very good policy. Modern theories of financial planning suggest that assets should be allocated across a number of asset types. The philosophy is that no one can predict the future returns on assets. By having your assets spread across a range of asset types, you reduce the risk if one particular asset class has a poor return. It is hoped that assets held in other classes will compensate for this poor performance. In this case, approximately half your investments are in superannuation, with the balance divided between cash, equities and real estate. Note how the percentage of cash is increasing as the age increases. The final graph for statistics displays what Financial Mappers calls your investment profile. This profile is calculated only on the investments held outside your retirement accounts. The description is based on the percentage of cash held and is divided into 20% allocations of cash held, plus an additional allocation where all assets are held in cash. These profiles are called no growth, which is 100% held in cash, low growth, conservative, balanced, high growth, and aggressive. It is important to understand that these terms may be used to describe the style or performance of a managed fund. However, their calculation is unlikely to be the same as that as in Financial Mappers. The report, Check Your Plan Outcomes, poses a set of questions for you to consider if you have achieved what you set out to do with your plan. It is also a report your advisor may use to take you through the key features of your plan and how they have designed the plan to meet your specific needs. The first questions simply ask, have you reached your financial targets at the end of both the savings and the retirement phase? There is a small description written as, at the end of your 15-year savings plan, you will be 64 years old. It is estimated that in present value, your home will be worth $709,000, your investments will be worth $659,000, and your retirement funds will be worth $968,000. Your investments will be yielding a real return of 4.95%. What a powerful statement! Instant, valuable information, easy to read and understand. The next question asks if you have achieved those personal financial goals you had decided to save for as part of your investment plan. Note that it includes the retirement income as listed in your retirement plan. However, it does not tell you how long that retirement income will last. The debt servicing ratio is the percentage of your after-tax income allocated to the repayment of all debts, including any planned additional payments. Is your debt servicing ratio too high? Is an important question to consider. Do your investment returns reflect the risk-reward you want to achieve? Remember, the higher the reward, the greater the risk. Are you relying too heavily on one asset class, or do you need to rebalance your investment portfolio? Does your investment profile for assets held outside superannuation meet your risk tolerance? Saving for your retirement is central to any plan, and this section gives a detailed study of the first 5 years of your plan. The table displays your average salary, less tax, living expenses and your personal loan payments, your allocation to the investment plan together with unallocated income in reserve. This is income which has not been allocated to your personal budget for living expenses. The graph displays the allocation of your salary savings in the investment plan. Setting a realistic budget is important. This table shows the average annual budget expenses over the first 5 years of the savings and the retirement phase. Taking the time to develop a full and detailed budget of living expenses will be a very rewarding experience and something no one should skip over. You should challenge your current lifestyle choices and find a balance between spending now and later. Remember, you may live more than 30 years after you have retired, and surely you want to have the spending power to enjoy that time. The single most important thing you must monitor is the account balance of your transaction account, which is also referred to as your bank account. Here is an example of the first 5 years of the Easy Mode practice plan where the decision was made to do a $50,000 investment property renovation. Clearly you can see that there are insufficient funds to pay for this cost. In the virtual world of financial mappers, you will not be stopped from making that transaction. However, in the real world, your bank is not going to let you overdraw your $10,000 overdraft facility. The facility is displayed as a red bar across the graph. Once your withdrawals go beyond that limit, the bank is going to say no. This is one time financial mappers cannot automate a response. It will simply display the information on the graph and in your data view so you can determine where the money was being spent. The choice would be to delay the renovations until you have saved the $50,000, or you could refinance the loan, adding the additional money. The loan amount would be deposited into the transaction account to fund the renovations, and your account balance would be above the overdraft limit. Another option is to sell some of your other investments. The next question asks, in your nominated drawdown, are you spending your investment capital or retirement funds too quickly? If you are, funds may not be available in the later stages of your retirement to meet your living expenses. Looking at these particular graphs, they tell a story where the viewer may want to go back and rethink. Look at the first year. The retirement plan has nominated $90,000 retirement income, but in the first year you have nominated to draw down around $96,000 from your superannuation and another $11,000 from your share portfolio. That is, you have overfunded the retirement income by $18,000. This could be resolved by not commencing the drawdown of your shares until year 3. You could also adjust the number of years you want to draw down your superannuation. However, in this sample plan, the percentage of fund balance has been activated. It is clear that 10% of your superannuation account is more than required for the nominated retirement income. You could say reduce the percentage from 10% for the first 5 years to 8.5%. On the other hand, you should consider whether your saving plan has been so successful you can afford to draw down more than $90,000 in retirement, or you may choose to save less so that your targets are met. This is a very clever thing about financial mappers. You can instantly change part of your plan, and the consequences of that change are seen immediately. This is why modelling software is so valuable to you and your financial advisor. This lets your advisor quickly change any part of the plan during your review meeting, and you can both see the effects immediately. And of course, they can quickly print out one of these short reports to show all the new outcomes. Is your insurance cover adequate? The information on this question will only be displayed if you have previously created the insurance needs report and entered the details of your insurance policies. The first table lists your investment income and expenses. You will notice that the warning symbol has been entered because the investment income is less than that of the expenses. If for any reason you were unable to work in one of the first 3 years of the plan, then you may not be able to support your investments. The next table lists how much you are able to sell from your liquid investments in any year. These are funds held in your cash accounts, managed funds and share portfolio. These are accounts you can liquidate quickly to make up any shortfall displayed in the first table. The last table lists the value of your various insurance and policies for each of the first 3 years of your plan. All reports will display the table showing which modulators are activated to ensure you're not creating a report where you may have accidentally left one of your modelling tools either on or off. The final question is, should I seek further advice from either my accountant or financial advisor? All the questions asked in this report are concepts you need to understand if you are building your own financial plans. Both the help file and the video help files are aimed to improve your financial literacy. ASIC's website will also give you a lot of information together with any number of books published by well-known Australian authors. If you elect to use a financial advisor, these are concepts you need to understand, and I am sure that your advisor will find it easy to engage with you if you have an understanding of how he or she is creating a plan which is going to meet your long-term financial needs. The insurance needs evaluation is really a self-evaluation because there will be times when the software will ask you to enter information only you can answer. There is an important concept you need to understand when using this report. While there are 3 years of information, these are not to be used sequentially. The concept is to consider the financial implications of an adverse event in any one of these 3 years. For example, what happens if you are too ill to work for all of year 2? It only tells you what the cash flows are likely to be for that 1 year based on the information you have supplied in this report and the information gathered from your plan. There are 3 adverse events to be considered. Risk of accidental sickness, so you cannot work for 12 months. You suffer a permanent and total disability, such as being confined to a wheelchair. You die and you want to ensure your loved ones are financially secure. The first item you will see is a snapshot of your finances for each of the first 3 years of the plan. This snapshot will list your current salary, which may not be available, together with any investment income, your expenses. You will note there is a line called optional expenses. When you create your advanced plan personal budget, you can tick the optional expense box. An optional expense is an expense you can suspend for a time if you are not working and would not spend that money if your income was severely impaired. Your current loan balances are also important because you may want to use some of your insurance funds to pay out those loans, or you may need to sell an investment so that the loan can be repaid. The net value of your assets lets you consider what may be sold if the need should arise. The full list of liquid assets allows you to choose which of those assets you may decide to sell. These funds are sometimes referred to as emergency funds. This easy mode sample plan had entered a set of insurance cover previously. Normally you would need to enter this information. Note that while you can enter the cost of these policies, the money is not automatically deducted from your budget. Some of these policies may be in your superannuation fund, so you may need to check that out first. The first adverse event is the possibility that you are unable to work for 12 months due to accident or sickness. This section is quite tricky because your accident and sickness entitlements and your trauma insurance policies are all dependent on the type of policy. That leaves some questions unanswered. However, if you could not work for 12 months, it is likely to be something serious enough to be covered by most policies. The software has automatically made the assumption you will receive your income protection cover of the $60,000 nominated. You will be asked to enter any Social Security entitlements to which you may be entitled. The last two lines list your emergency funds and trauma insurance. Trauma insurance has not been included in the calculations as your entitlement will depend on your policy. The chances are that if you are permanently and totally disabled, a complete change will need to occur with your investments. This section is aimed to help you think through what you would need to change. There are two entries you will need to make. The first is any immediate financial obligations. These may be additional medical costs, changing or modifying your current home, or repaying some of the loans from your insurance lump sum. You will need to do an estimation of what money will be left for you to invest. In the section Estimated Returns, the program has pre-filled the returns as 4.5% of the balance of the insurance cover invested and 4% of other investments. The program will then calculate the annual income you are likely to receive after taking all this into consideration. Of course, you may also be entitled to a once-off trauma cover depending on the policy. When did you last check your insurance policy so you know exactly what you are covered for? In this section, dealing with financial needs of your dependents should you die, you will be asked to complete the following: debts to be repaid, an additional living allowance for the first year, giving your family time to grieve and get their finances in order, the estimated net value of investments from which your family can earn an income, any salary your partner may earn to help support the family. This is a very detailed assessment and something you may like to discuss with your insurance broker or financial advisor. You may like to send your insurance broker a copy of this insurance needs evaluation. The next set of reports are detailed specific summaries. The name of the sample plan used in the reports are listed. The reports are 5-year loan report, debt management report, superannuation report, self-managed superannuation report, and the tax estimator. The 5-year loan report and the debt management report provide the same information, but the second report lists strategies to reduce debt. These reports give a very detailed look at loans over the first 5 years of the plan. Two of the strategies are evaluating the effect of a rise in interest rates and how one could reduce debts by applying a percentage of optional living expenses for a short time. Optional expenses are those expenses which have been ticked as optional in the personal expenses and are those one could not spend if a person's income was restricted for any reason. Before the report will open, the user may change the default settings of a 2% rise in interest rates and apply 50% of optional expenses to the reduction of debt over the next 5 years. The report will not open until the button Save and Review Report is applied. The report opens with 3 graphs: loan balance and the start of each year divided into 3 categories. The loan payments, including any planned additional payments, the allocation of capital and interest for each year of all the loans. The remainder of the report will not be generated until the button View PDF is selected. The first issue addressed is the debt servicing ratio. A debt servicing ratio is the percentage of after-tax income used to repay all loans, including personal loans and credit card debt. Financial Mappers includes 2 ratios. The first includes any planned additional payments and the second excludes those additional payments. Note how the report gives a word description such as very high, high and moderate depending on the percentage. Very high is any ratio 30% or higher. The interest rate risk assessment is a concept developed by Financial Mappers. The assessment applies only to home and investment loans. The intention is to consider the effect of the nominated interest rate rise, which defaults to 2% on all loans which have a variable interest rate in any of the first 5 years. The program calculates how much the loan payments will rise. From this amount, the program automatically deducts any allocation to additional loan payments. The reasoning is that those additional payments can be applied to the loan increase and have already been accounted for in the plan's cash flows. The table then calculates how much extra money will need to be found on both an annual and monthly basis. In this example, no additional payments are planned for the first 3 years, so the person is exposed to the full effect of the 2% interest rate rise. In the last 2 years, sufficient additional payments have been planned to cover the cost of the increased loan payments. This section is intended to give the user a way to find some additional money to assist in debt reduction. In this plan, $5,000 has been listed as optional expenses, and it was elected that one could afford to use 50% of this value to repay debt. Note that this is just a theoretical example and the money is not actually applied to the loans. If the user saw value in this strategy, they would need to consider which loans should have the increased loan repayments. The table shows that by making additional payments of $2,500 a year, by the end of the 5-year period, the debt will be reduced by an additional $12,500 and the interest saved is likely to be approximately $2,650. The personal living expenses for each year is displayed. This information is to help you decide where expenses could be reduced. You will recall that the investment or savings plan allocates the loan expenses net of rental income. This table calculates what the cost will be for each year and the expenses as a percentage of your gross salary. This information is very helpful when planning what percentage of salary should be saved to repay home and investment loans, investments, and any personal goals. This section displays all loan balances and loan repayment schedules and includes the loan type. This table is an amortization schedule for each loan and includes the interest rates. This information may be helpful by selecting which loan should be repaid first. In this report, there are no new loans or refinanced loans. The debt management report is in the same format as the 5-year loan report, but this report includes strategies for debt reduction as displayed here. Only the graphs of the tax estimator can be saved as a PDF. It is very important to heed the warnings about the calculations in this tax estimator, which states, "The calculations are of a general nature using a simplified format and as such are not suitable for use regarding matters of taxation. No financial decision should be based on this information without obtaining advice from a person licensed to give tax advice. Tax rates may change in the future." Financial Mappers is a multi-country modelling tool, and as such, each account gives options to tax that account as either part of the standard method of taxation using a progressive country-specific tax rate, taxing the account at a specified tax rate, or allowing the income to be tax-free. At times, governments may provide special incentives for saving by providing tax-sheltered investment accounts. Both income tax and capital gains tax are calculated according to the selected tax schedules. All capital gains tax is paid by the transaction account. With income tax, the total is distributed proportionally between investment income and income listed in the personal budget. In the retirement phase, that income will include the nominated drawdown in the retirement plan and any pensions from external sources. In the retirement phase, income from superannuation is tax-free. Note year 21, where the investment property has been sold, generating $1 million profit and generated a very high capital gains tax in that year. The effect of the capital gains tax on properties which have been held for a very long term are often underestimated. It is a timely reminder to consider the potential capital gains tax should it be necessary to sell assets held for a very long time. Where one may expect some capital losses on the sale of assets, if these assets are sold first, the losses can be applied against future profits if there is a planned sale of more assets over the retirement phase. The data view can be viewed online for each 5-year period. In this example, years 6 to 10 of the Advanced Practice Plan is displayed. Note how all the details of the taxable income taxed at the income tax rate have been displayed by clicking on the underlined heading. For each account, the net income is displayed. The program does allow you to enter personal tax deductions and also home loan payments for countries where this is applicable. The interest on the investment loans, which are tax deductible, are listed. Where the depreciation and building write-off information has been entered, these are included as non-cash tax deductions. In this 5-year period, there is no income taxed at a specified tax rate or tax-free. In year 10, shares and managed funds have been sold, generating profits. Tax credits may be either non-refundable, which means the benefit expires when the credit equates to the tax due, while refundable tax credits, as is the case with imputation credits due on shares, result in a tax refund if the credit is greater than the tax due. Income tax is paid by the transaction account for that tax allocated to investment income and by the personal investment budget for that tax allocated to personal income. The allocation is proportional according to the source of the income. Capital gains tax is always paid from the transaction account. Finally, the average tax rate is calculated for both income tax and capital gains tax. That concludes the Tax Estimator report. The final set of reports are called optional extras, each of which have a very special purpose. The reports are plan outcomes using modelling tools, which will be discussed in the video for how to use modelling tools. Plan outcomes for 3 time periods. This was previously called the progress report, and you may on occasion see reference to this term. Statement of financial position by year, in this case year 10 has been chosen. Statement of financial position, first 3 years summary. Reports using modelling tools will be discussed in detail in the video how to use modelling tools. However, as a sneak preview, the top set of 8 graphs are displayed when a report is generated. The grey columns is the year-by-year value, with the line displaying the effect after the application of the nominated modelling tool. The graph at the bottom of the page displays the first 10 years of the plan overlaid with the results of a set of 4 10-year economic cycles which occur between 1986 and 2011. The report Financial Position First 3 Years Summary was previously called the 3-year investment strategy. The reason is that before the report is generated, the user or the financial advisor is given the opportunity to write their plans for the next 3 years in the highlighted space. The following was written for this report. My strategy for the next 3 years is to be more responsible with my money. I want to reduce my personal debts and start building wealth. The first table lists the purchases which have been made in the first 3 years, together with any new loans which have been made in that time period. Expanding the first page, you will see the investment strategy written previously to be included in the report. The report gives a graphic presentation of the net value of investments, home and retirement accounts, together with a pie graph showing the average asset allocation for the first 3 years. For each of the years, the value of the assets and liabilities are displayed. Note the titles in the last 3 rows of each table. The net value of assets are displayed together with statistics, investment profile, and asset allocation. Personal income and expenses, together with investment income and expenses, including home loans, are displayed. The last line displays the net outgoings. Because the figures are negative and therefore displayed in red, the investment expenses are greater than the investment income. The savings allocation from salary shows where that money has been allocated. Insurance policies, together with their costs, are also displayed. The summary places your salary and net assets in a bracket and lists which assets you buy or sell during the first 3 years. The section on the right allows you to write notes. The final slide is a graphic overview of assets at the start of the year, asset categories at the start of the year, loans at the start of the year, allocation of savings from salary. That concludes the report. Financial Mappers Pro is a product provided by accountants, financial planners, mortgage brokers, superannuation fund managers and SMSF advisors. This product allows the advisor to share plans with their client and create a report for the exclusive use of their clients. If you are using Financial Mappers Pro, there may be additional reports displayed in a fourth panel. For those not using Financial Mappers Pro, these reports are developed so that you may share information with your advisors. Enjoy the magic of Financial Mappers.